$89,000. That's what a single Bitcoin will cost you today. And every few days, someone asks me the same question, Warren, is Bitcoin finally going to zero, or is this the beginning of a new monetary age? They ask with wide eyes, excitement in their voice, sometimes fear, but always with the assumption that I'm going to give them a prediction. They forget I don't predict. I calculate, because speculation is built on emotion and investing is built on arithmetic. And the arithmetic behind Bitcoin at $89,000 per coin, well, that arithmetic isn't pretty. Last week, a gentleman called me, said he emptied part of his retirement account to buy Bitcoin. Thought he was being clever. He'd watched his nephew turn $10,000 into $3 million, and now he wanted to do the same. He asked if Bitcoin was going to $1 million, like the experts say, or if the government would shut it down, or if it would become the new global currency. I listened politely. Then I told him something no one wants to hear in a market like this. For something to go to zero, it doesn't have to be worthless. It just has to stop attracting new buyers. Tulip bulbs once traded for the price of a house. That didn't make them real estate. It made them a bubble. And what people forget is that tulips didn't crash because the flowers suddenly lost their beauty. They crashed because one morning buyers simply vanished. A market without buyers doesn't drift lower. It collapses. Bitcoin is not special in this regard. It is governed by the same psychology, the same fear, the same greed that has driven every speculative mania since the 1800s. It rises on belief and collapses on doubt. And belief can evaporate far faster than mathematics. Before I tell you why Bitcoin can fall much further than most people imagine, let me tell you why smart people believe in it. Because smart people do believe in it. And that's what makes this so dangerous. When irrational people buy something, you shrug. But when intelligent, wealthy, influential individuals pile into an asset with no intrinsic value, that's when you know the mania has legs. Michael Saylor, for example, he didn't just buy Bitcoin. He turned his entire company into a leveraged Bitcoin play. 582,000 coins, $60 billion in exposure. BlackRock, the largest asset manager on earth, now offers Bitcoin ETFs. Fidelity allows retirement accounts to hold Bitcoin. Serious institutions, not teenagers on their phones, are now fueling the demand. But institutional participation does not remove risk. It magnifies it. Institutions buy more at the top than anyone else. They herd. They chase. They get the same fear of missing out everyone else gets. And when they're wrong, their losses are spectacular. You see, the Bitcoin story sounds compelling on the surface. Digital gold, fixed supply, decentralized, immune to inflation, immune to government interference, too big to ban. It sounds like the perfect antidote to a world drowning in debt and money printing. And if you don't look too closely, if you don't examine the mechanics or the assumptions or the arithmetic, then yes, Bitcoin looks like the ultimate 21st century asset. But the moment you look beneath the surface, the moment you ask even the simplest questions, the narrative falls apart. And this is where investors get angry with me. Because I'm not fighting their beliefs, I'm fighting their math. Let's start with the fixed supply argument. Bitcoin is capped at 21 million coins. No more will ever be created. That sounds impressive until you realize something. Scarcity doesn't create value. Scarcity only creates value when the thing being limited has intrinsic usefulness. There are only a few. Paintings by Vermeer. That makes them valuable. There are only so many Stradivarius violins. That makes them valuable. Bitcoin has the same scarcity as digital trading cards or online video game items. Scarce, yes. Useful, no. Then they say, Warren, dollars aren't backed by anything either. And I smile because they're wrong, but they're wrong in an understandable way. Dollars are backed by the one asset Bitcoin will never possess, the ability to extinguish your tax obligations. The United States government requires that you pay taxes in dollars. It pays its employees in dollars. It settles its debts in dollars. That creates permanent, immovable demand. Bitcoin has no such mechanism. It only has buyers as long as people feel like being buyers. Then there's the digital gold argument. Gold, they say, has no intrinsic yield either, but gold has survived as a store of value for thousands of years. And that's true. But gold has two things Bitcoin does not: physical properties and universal recognition. Gold is used in electronics, jewelry, aerospace, medicine. It has industrial utility, and more importantly, every culture on earth, from ancient Egypt to modern China, recognizes gold as valuable. Bitcoin is only valuable to those who believe in Bitcoin, and belief is not intrinsic value. Then they talk about technology, blockchain, decentralization, smart contracts, immutable ledgers, and I tell them the same thing I told people during the dot-com bubble. You don't need to own the speculation to benefit from the technology. You didn't have to buy pets.com stock to benefit from the internet. You didn't have to buy WorldCom to benefit from telecommunications. And you don't have to buy Bitcoin to benefit from blockchain. Technology does not guarantee that the token associated with the technology will have value. That's the mistake people have been making since 1999. But the biggest issue with Bitcoin isn't technological or philosophical. It's psychological. The only way Bitcoin maintains its value is if the next buyer is willing to pay more than the last buyer. That's not investing. That's the greater fool theory. When you buy a farm, you don't need a greater fool. You have crops. When you buy a business, you don't need a greater fool. You have profits. When you buy an apartment building, you don't need a greater fool. You have rent. When you buy Bitcoin, you need someone eventually to take it off your hands at a higher price. The moment that chain breaks, the moment buyers pause, the moment sentiment turns, the asset collapses. I've seen this pattern dozens of times in my life. 1980 gold mania, 1999 dot-com, 2006 housing mania, 2021 meme stock mania. Every one of them had the same ingredients: a kernel of truth, rapid early gains, sophisticated sounding explanations, and the belief that society had entered a new paradigm. And every one of them ended the same way, with people who bought at the top losing everything they couldn't afford to lose. Now here's the uncomfortable math no Bitcoin holder wants to hear. If Bitcoin goes from 100,000 to zero, it won't happen slowly. It will happen violently. Because when an asset is worth only what the next person will pay and the next person vanishes, price does not decline in a straight line. It falls off a cliff. And Bitcoin has already shown this pattern. In 2017, it fell 84%. In 2021, it fell 77%. These are not dips. These are collapses. And history suggests it can collapse again. Let's get to the real question people keep avoiding. Not whether Bitcoin is innovative, not whether blockchain is interesting, not whether governments print too much money. The question any rational investor must ask before buying an asset priced at $89,000 is simple. Where does the next dollar of value come from? Because if the answer is the next buyer, then you're not investing. You're gambling. And gambling works wonderfully until the moment it doesn't. I've been around long enough to see every argument for every speculative asset under the sun. And I can tell you, the arguments surrounding Bitcoin today are identical to the arguments surrounding every failed mania of the past century. They all start with the claim that this time is different. People said the same thing in 1980 when gold surged to $850 an ounce. They said the dollar was dead, inflation unstoppable, and gold the only true store of value. They said governments couldn't be trusted and everything was changing forever. It sounded smart. It sounded convincing. It sounded exactly like Bitcoin believers today. And then what happened? Gold didn't just pull back. It collapsed 65% and didn't hit those same levels again for 28 years. People forget that part. The part where entire decades disappear from your financial life because you bought something at the wrong price. They remember the believers, the passionate arguments, the narratives, but they ignore the mathematics that always follows when an asset becomes the playground of speculation. Bitcoin has already gone through multiple collapses. each time taking out the majority of people who bought late. And today, with the price at $89,000, the arithmetic is more unforgiving than ever. Let me explain something most Bitcoin holders refuse to consider. If Bitcoin goes to zero, or close enough to zero that the outcome feels identical, it won't be because the technology failed. It won't be because a hacker broke the blockchain. It won't be because a government banned it. It will be because liquidity evaporates. That's all it takes. A shortage of buyers. And with an asset whose only source of value is the next buyer, a shortage of buyers is fatal. Picture this. A large institution decides to sell a significant portion of its Bitcoin holdings. Maybe because they're rebalancing. Maybe because regulators tightened liquidity requirements. Maybe because they simply want to lock in gains. It doesn't matter why. What matters is the size of the seller. Bitcoin doesn't trade like a stock with a consistent buyer base. It trades in waves of enthusiasm. When a major seller appears, the buyers dry up fast because everyone assumes the price is about to fall. So no one steps in. The price drops. Liquidations trigger. Stop losses fire. Margin positions unwind. Before you know it, a small wave has turned into a tidal wave. And this is the part Bitcoin investors underestimate most. The market structure is fragile, extremely fragile. It's dominated by leverage. It's dominated by derivatives. It's dominated by traders using borrowed money to chase short-term swings. That's why when Bitcoin falls, it doesn't fall quietly. It falls with violence. A 5% drop becomes a 10% drop. 10 becomes 20. 20 becomes 50. And all it takes is one large seller to start the chain reaction. People ask, Warren, could Bitcoin actually go to zero? And I tell them the truth. Anything with no intrinsic value can go to zero. A farm can't go to zero. A business producing profits can't go to zero. An apartment building generating rent can't go to zero. Bitcoin, gold, tulips, collectibles, they all have the same problem. Their value depends solely on human opinion. Change the opinion and you change the value. Change it enough and the value disappears entirely. Let me illustrate something crucial with a simple analogy. Imagine someone offers you two choices. Choice 1, a goose that lays golden eggs. Choice 2, a golden egg that will never lay another one. Which would you choose? The goose, of course. The goose produces. It creates value continuously. The golden egg is static. It doesn't generate anything. Bitcoin isn't the goose. Bitcoin isn't even the golden egg. It's more like a shiny rock that someone calls valuable because other people call it valuable. But one day, someone may stop calling it valuable. And that's the end. The Bitcoin evangelists will argue back. They always do. They say Bitcoin is immune to inflation. They say the fixed supply makes it the perfect hedge. But the hedge argument collapses under scrutiny. A hedge is only useful if it moves predictably when other assets move predictably. Bitcoin doesn't do that. When inflation rises, sometimes Bitcoin rises, sometimes it collapses. When markets crash, sometimes Bitcoin rises, sometimes it collapses. A hedge isn't supposed to behave randomly. A hedge is supposed to behave reliably. Bitcoin doesn't behave reliably. It behaves emotionally. Then they say Bitcoin is decentralized and therefore unstoppable, but that's another half-truth. The network might be decentralized. The price is not. The price is determined by centralized exchanges, centralized liquidity pools, centralized market makers, and centralized custodians. When the exchanges halt withdrawals, when liquidity dries up, when regulators step in, when the platforms buckle under stress, decentralization won't protect holders. It never has. I've watched thousands of assets over my lifetime, and the one universal rule that never breaks is this. When an investment's only promise is the possibility of selling it to someone else for more money, then the last buyer becomes the victim. And in a mania, there is always a last buyer. Always. The person who paid the most. The one holding the bag when the music stops. And the tragedy is that the last buyer is usually someone who couldn't afford to take the loss. Now let me show you why Bitcoin at $89,000 is more dangerous today than Bitcoin at $8,000 or even $30,000. It's simple arithmetic. At $8,000, Bitcoin could increase tenfold before hitting 80,000. That's tremendous upside. But at 89,000, the upside is limited unless you believe it will go to 1 million, 2 million, 5 million. And belief is not a strategy. Meanwhile, the downside remains exactly what it's always been, 100%. Zero. The amount you can lose never changes. The amount you can gain shrinks as the price climbs. That's a terrible trade. There's a moment in every bubble when the people inside it stop asking questions. They stop considering risk. They stop doing arithmetic. They stop thinking about consequences. All they care about is the line going up. And they convince themselves that as long as enough people believe, the line will continue rising forever. Human psychology doesn't work that way, and arithmetic certainly doesn't work that way. The laws of mathematics do not bend for enthusiasm. That moment when people stop questioning is always the most dangerous phase, and it's the phase Bitcoin is in right now. You can see it everywhere. When Bitcoin was $800, people debated whether it had a future. When it was 8,000, people debated whether it was a bubble. When it was 30,000, people debated whether it was sustainable. But now, at 89,000, no one is debating anything. They're celebrating. They're convincing themselves that the biggest risks have already passed. They're telling themselves that institutions will save them, that adoption will save them, that scarcity will save them. But optimism doesn't protect you from arithmetic, and $89,000 doesn't leave any room for disappointment. Let's talk about the most fragile part of Bitcoin's entire architecture, the belief that it's too big to fail. People say that because institutions are involved, Bitcoin can't collapse, that because companies hold it, because ETFs hold it, because hedge funds hold it, the price is protected. But here's something most investors never learned. Institutions don't stabilize bubbles, they amplify them. And when the bubble bursts, institutions don't cushion the fall, they accelerate it. Let me tell you a story. In 2008, big banks were the reason housing prices skyrocketed. They created the demand, they created the leverage, they created the illusion of invincibility. And when the brakes were hit, those same institutions magnified the collapse. They didn't protect anyone. They destroyed trillions of dollars in wealth because they were all doing the same thing at the same time. That's what happens when institutions crowd into a trade. They don't make it safer, they make it more fragile. The same thing happened in the dot-com bubble. Venture capitalists, pension funds, mutual funds, they all piled in during the late stages. They weren't early adopters. They waited until momentum forced their hand. They bought the very top of the bubble because they feared missing out. And when markets cracked, they all exited simultaneously. You can't have stability when the largest players behave like panicked crowds. And today, with institutional Bitcoin exposure higher than ever, people are making the same fatal assumption, that size equals safety. Size does not create safety. Diversification does. Cash flow does. Intrinsic value does. Bitcoin has none of those things. Now let's talk about the mechanism of collapse, the pressure point no one likes to mention, liquidity. Bitcoin lives and dies by liquidity. The moment liquidity dries up, the price doesn't glide downward. It drops vertically. And Bitcoin's liquidity is one of the thinnest among large assets. At any given moment, only a fraction of Bitcoin is available for trading. The rest is locked up, lost, held long-term, or stuck in custodial platforms. So when people rush to exit, they're all pushing through a narrow door. Picture thousands of people packed into a theater that has one single small exit. If one person yells fire, everyone runs for the same door, not because the fire is real, but because the panic is. That's how Bitcoin trades. When the selling starts, The exits aren't large enough to handle the demand. The price collapses not because the asset lost value, but because the market structure can't handle the stress. This is why Bitcoin's crashes are always so violent. In 2017, when Bitcoin hit nearly 20,000 and crashed to 3,200, that wasn't a coincidence. That was market structure failure. In 2021, when Bitcoin reached nearly 70,000 and collapsed into the teens, that wasn't a coincidence either. That was liquidity evaporating and leverage unwinding. And today, with Bitcoin at 89,000, the leverage is higher, the institutional exposure is deeper, the derivatives are more complex, and the liquidity is more fragile than ever. People forget that derivatives, options, futures, perpetual contracts didn't reduce Bitcoin's risk. They multiplied it. They gave traders the ability to control 10 times, 20 times, even 100 times the Bitcoin they actually owned. And when the market turns against them, when even a 5% move happens, those leverage positions don't lose 5%, they lose everything. And when they lose everything, the positions liquidate automatically, forcing the exchanges to dump the underlying Bitcoin onto the market at any price available. That's how you turn a small correction into a full-scale collapse. It's not emotion. It's not fear. It's programming. Forced liquidation is automatic. Now, let me talk about something most Bitcoin holders refuse to admit, the competition problem. Bitcoin isn't the only cryptocurrency, it's just the oldest. Ethereum, Solana, and thousands of others exist. Every cycle, new coins appear with better technology, faster transactions, lower fees, more utility. Bitcoin is a brand, not a technology leader. And brands can be replaced. MySpace was replaced by Facebook. BlackBerry was replaced by the iPhone. Netscape was replaced by Google. Being first doesn't guarantee being best. And it certainly doesn't guarantee survival. When Ethereum introduced smart contracts, the majority of actual utility moved off Bitcoin. When Layer 2 networks appeared, they didn't strengthen Bitcoin, they bypassed it. And every new innovation chips away at the belief that Bitcoin is irreplaceable. Bitcoin's defenders call it digital gold, but even gold isn't immune to competition. Silver competed with gold. Paper money competed with gold. Digital payments compete with gold. Gold survived because it has physical properties. Bitcoin survives only because people believe in it. And belief can be rerouted anywhere. There's another uncomfortable truth. Bitcoin's security depends entirely on miners being profitable. If mining rewards fall and energy costs rise and the price doesn't keep climbing, miners shut down. And when miners shut down, the network slows. A slow network becomes vulnerable, not doomed but weakened. We've already seen periods where mining difficulty dropped sharply because miners could no longer operate profitably at lower prices. What happens if Bitcoin crashes from 89,000 to 30,000? Or to 10,000? Or to 3,000? Mining becomes unprofitable fast. That's not a flaw, it's a design choice. But it means Bitcoin's network strength is tied to price, not utility. This creates a paradox most Bitcoin buyers never consider. Bitcoin needs high prices to stay secure, but high prices increase the risk of collapse. And collapse weakens the network. So the very feature that secures Bitcoin mining is dependent on the thing that makes Bitcoin a bubble, speculation. Now let me tell you about the real danger. The danger that keeps me up at night when I think about inexperienced investors buying Bitcoin at $89,000. It's not the technology, it's not regulation, it's not competition, it's not mining economics, it's human emotion, fear and greed. These two forces have destroyed more wealth than any recession, any war, any financial crisis. Fear makes people sell at the bottom. Greed makes people buy at the top. And Bitcoin thrives on both emotions. That's the problem. There's a point in every mania where the crowd stops thinking and starts chanting. You can hear it in every bubble. You could hear it in 1929. You could hear it in 1980 with gold. You could hear it in 1999 with dot-com stocks. You could hear it in 2006 with housing. And you can hear it today with Bitcoin. The same phrase is repeated again and again like a ritual. It can't crash. It's different this time. Institutions will save it. The price can only go up from here. Whenever I hear those phrases, I don't think of confidence. I think of danger. Because the moment everyone stops worrying is the moment the collapse becomes unavoidable. What causes the collapse is not usually some dramatic event. It's not always a hack or a regulation or an exchange failure. Those things can accelerate a crash, but they're not the root cause. The root cause is far simpler. It's disappointment, a single moment when expectations are not met. The day the narrative breaks. Investors expect Bitcoin to rise forever. They expect mainstream adoption to continue. They expect institutions to buy endlessly. They expect the halving to push prices higher every single time. The moment those expectations stop being fulfilled, the bubble pops. It could be something tiny. Maybe a major ETF unexpectedly sees withdrawals instead of inflows. Maybe a government files a lawsuit against an exchange. Maybe a prominent Bitcoin whale moves coins to a trading wallet. It doesn't matter what the spark is. All that matters is that doubt enters the system. A crack appears in the optimism, and in a market held together entirely by belief, a crack is all it takes. Once doubt appears, the psychology flips faster than most people can imagine. Bitcoin holders are passionate on the way up, but they are terrified on the way down. I've seen this behavior for 7 decades. The people who cheer an asset at the top are often the first to abandon it when the decline begins. Because deep down, they know what they bought. They didn't buy a business. They didn't buy cash flow. They didn't buy assets. They bought hope, and hope evaporates the moment the price falls. Think about what happens when Bitcoin falls from 89,000 to 70,000. That's where the first tremors begin. Leverage traders start liquidating. Options traders see premiums collapse. People who bought late start to question whether they made a mistake. The true believers tell everyone to buy the dip, but the new buyers don't show up. That's when panic begins. But panic doesn't start loudly. It starts quietly. People tell themselves they'll sell if it drops just a little more. Then it drops a little more. They tell themselves they'll sell if it breaks 60,000. Then it breaks 60,000. Now the headlines appear. Analysts turn bearish. Exchanges see heavy activity. The ETFs see outflows. Traders can't meet margin calls. Suddenly, thousands of coins hit the market at once. The price falls faster. 55,000, 50,000, 48,000. The long-term holders insist it's temporary. But deep inside, even they feel the fear. They've seen this before. They remember 2017. They remember 2021. They remember how fast it can go wrong. At 40,000, the psychology changes completely. That's when people who swore they'd never sell begin to question everything. And here's the critical part. Bitcoin's value doesn't decline because the technology changed. It declines because buyers vanish. Everyone who wanted to buy already bought. Everyone who planned to hold forever discovers they didn't mean forever. They meant as long as it keeps going up. That's how bubbles work. People misunderstand what sends Bitcoin to zero. It's not a government ban. It's not a hack. It's not competition. It's apathy. Complete, total apathy. When the price collapses far enough, the excitement dies. The influencers stop talking about it. The media moves on. The institutions quietly write down their losses. The traders move to the next shiny object. And without enthusiasm, Bitcoin has nothing. No cash flow, no yield, no utility, no industrial use, no intrinsic value. Just a story that people stop telling. I've lived long enough to watch entire asset classes disappear after their story ended. Railroad bonds that were once worth fortunes became worthless paper. Dot-com stocks that once dominated the headlines vanished in bankruptcy courts. Residential real estate investments promising 20% annual returns in 2006 turned into abandoned subdivisions. The common thread? The story stopped. The excitement ended. And when the story ends, speculative assets die. Bitcoin's final stage will follow the same arc. First comes the loss of momentum, then comes the loss of liquidity, then the loss of confidence, then the loss of attention. And once the market stops paying attention, the price doesn't just fall, it evaporates. One day Bitcoin will fall from 20,000 to 10,000 faster than anyone believes possible. Then from 10,000 to 4,000. Then from 4,000 to levels where mining becomes unprofitable, where exchanges shut down smaller operations, where the incentive to continue supporting the network collapses. Maybe Bitcoin doesn't hit zero exactly. Maybe it survives for decades as a curiosity, trading for a few $100s. But from an investor's standpoint, from the perspective of someone who paid $89,000 per coin, a collapse from 89,000 to 400 is indistinguishable from zero. The wealth is gone. The dream is gone. The speculation is gone. And here's the part no Bitcoin believer ever wants to hear. If Bitcoin does go to $1 million one day, almost no one will benefit, because very few people will hold through the collapses on the way there. Human emotion won't let them. A 90% crash wipes out the true believers every time. They're forced to sell, or they panic, or they lose access to their wallets, or an exchange fails. The gains belong to the handful who bought early and never sold. Everyone else is just passing the same coins around. When you buy a productive business, you don't need any of that. You don't need perfect timing. You don't need perfect psychology. You don't need someone to buy from you at a higher price. You collect earnings. You collect dividends. You watch the value of your ownership grow because the business itself grows. That's investing. Bitcoin is not investing. It never was. It never will be. People call me old-fashioned for saying that. They call me out of touch. They say I don't understand technology. But technology has nothing to do with it. Arithmetic does. Human behavior does. Market cycles do. Fear and greed do. I don't need to understand cryptography to understand speculative manias. I've lived through more of them than most people read about. And they all end the same way. Suddenly. Let me leave you with one final thought. If you own Bitcoin today at $89,000, I'm not telling you to panic. I'm telling you to think. Think about what you actually own. Think about what produces value and what does not. Think about whether you're investing or speculating. Think about what happens if you're wrong. And then remember something Charlie Munger told me many years ago. The safest way to avoid losing money is to avoid situations where losing money is easy. Bitcoin, at these levels, makes losing money easy. In my 90-plus years of investing, I've never regretted avoiding something I didn't understand. But I've watched countless people regret chasing the thing they understood least. Bitcoin may not go to zero tomorrow or next week or next year, but the risks are enormous. The arithmetic is unforgiving, and the psychology is treacherous. And in markets, treacherous psychology always wins.